Welcome to the Education of a Financial Planner, where we look at the major concepts in financial planning through the lens of two quant investors who are learning the ropes of the planning process and how to help clients achieve their long-term goals. Learn along with us as experienced financial planner Matt Ziegler helps us understand the most important financial planning concepts that impact all of us and how we can apply them to achieve the best outcomes in our financial lives. In each episode, we will work through one major financial planning concept from the ground up and learn how we can apply it in the real world. From retirement to college savings to taxes to estate planning, we will cover a wide range of topics that apply to each of our everyday lives. We hope you will join us in our learning journey.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital or Sunpoint Investments.
All right, guys. Today we're going to talk about something a little different, and these are going to be a discussion around different things that I guess we're sort of talking to clients about that are on a lot of investors' minds. Jack and I kind of joke about this a lot, that, I'm sort of not in the camp of like hardcore macro forecasting and predictions, but at the same time, we all know that from working with clients, clients want to know that we are up to speed as to the things that are happening in the market. It's important. And being able to have intelligent conversations around, these major issues that, of course, drive the economy, drive the markets, where things are going. But it doesn't necessarily always mean that they're reflective in long-term investment strategies. And that's where sometimes the disconnect can happen. But I think, talking about these things, sort of looking at them and we'll get into what these are, but looking at them from a historical perspective, what investors should be maybe thinking about with these things. So we're going to talk about inflation. We're going to talk about AI and some technological innovations happening, market valuations, recessions, and then political and geopolitical, risks. And so all these things, of course, are going to influence a lot of things in the market, but they don't necessarily mean you should always be making changes to your investment strategy and your portfolio because of that. So I'm just sort of presenting that as sort of the intro here, because I think that's a sort of important disclaimer, or way to maybe intro this, if that makes sense. And so maybe I'll just let maybe Jack and Matt, if you guys want to comment on that, and then we'll sort of try to get into each one of these topics and how we're all thinking about things. And I think what you're going to find is that we're all going to bring probably a little bit different perspective to these things, but hopefully in totality, we're educating along the way and adding a little bit of value.
Yeah, but before we get into it, one of the things, I agree with you completely about this. These are not things in general that people should be adjusting their portfolios for. But one of the things I heard the Ritholtz guys say a long time ago is when you talk to clients, they expect you to have some idea what's going on with these things. You can't just say to someone, if someone calls up Matt and says, I'm really worried about inflation, I want to change my portfolio. Matt can't be like, that's a bunch of garbage. That's short-term predictions. You should not be doing that in your portfolio, and hang up on them. Or Matt also can't have zero knowledge of inflation. Matt can't just be like, I know nothing about inflation. Inflation doesn't affect our investment strategy. Leave me alone. You have to have some idea what's going on, and you have to be willing to talk about it, because this stuff is in the news every day and people think about it. So as much as we're believers, you can't adjust your investment strategy every day based on this. You still have to have some grasp of what's going on. I don't know if that's right, Matt, but that's kind of the way I look at it.
Look, I kept my eye on the Phillies for years because I got to talk to my dad about it. Just the same way my dad kept his eye on the Penn State football team for years because he would talk to his dad about it and whatever else. And I don't want to just equate this to sports, but I will say this is the type of thing that we have to be able to talk to clients about. And we're in this business because it's interesting to us. And we own businesses because this is interesting to us. So these topics are all fair game. We should always have opinions and views. And that doesn't mean we're going to generate new rules or do stupid stuff because of it. We're still disciplined investors. But we have to take it all in, drink from the fire hose.
Yeah, so to start drinking from the fire hose, we'll start out with inflation, because that's probably maybe one of the biggest things on people's minds. It was much, much higher. It's come down a little bit, but it obviously hasn't come down near the Fed target now. I'm just wondering, when you talk to clients about inflation, I mean, what are your general thoughts on it?
So first off, I know you guys are waiting for this. I did bring a song to the table for each of these categories because
Here
I
we
don't
go.
get to do this on, the Sunpoint webinars that we do quarterly when we do a more, brushed up version of this stuff.
They don't get
So
the songs on those?
they don't get the song takes, mostly because I'm just moderating in those conversations. So you guys get the dated humor and jokes. So I think the song for inflation for me right now in June 22nd of 2023 is when we're having this conversation. We should timestamp this for when the world changes tomorrow. Four Non-Blondes, you remember the classic song "What's Going On"?
Oh
Oh, yeah, I remember that.
This idea that I wake in the morning, I step outside, take a deep breath, and I get real high, and I scream at the top of my lungs, "What's going on?" And inflation right now, I think, is the ultimate what's going on, because we have the rear view mirror CPI readings that are still screaming along pretty high. And then we have the forward expectations of like inflation coming down. And when we talk about inflation with investments, we have to be saying what just happened in the past, rear view mirror, what's happening out the windshield right now. And then how is that influencing each of our investments? Because it's having different influences on different things. Very tied to Fed rates and everything else too. So as we look forward with inflation, we know it's coming down. We just don't know if it's falling off a cliff. Personal camp, I'm in the camp that, yeah, it's probably not going back down to like 2% or 1% or 0. But is it gonna stay really high? I hope not, but I don't think it will. So if we are settling into slightly above historical average inflation in the future, that's informing a lot of the investment assumptions and everything else. I gotta say this, and then I want your guys' take on the investment side of this. The other piece of inflation we talk about a lot in my job at Sunpoint is on the human capital side. And it's, look, if you're still employed and inflation hasn't pushed you out of your job, in many cases it has, some of the tech people and others we talk with, like that's the circumstance. If you haven't asked for a raise yet, this is the time to ask for the raise. If you haven't positioned yourself to benefit from this lift in prices and wage pressure, now's the time to do it. Been the time to do it. You got to think about that stuff too. But give me some investment take and some four non-blondes.
First of all, Justin, I'm going to need a raise here.
Yeah, I was going to say, I was going to ask you for a raise, Jack.
So if you can get that done.
Matt, can you give us a raise, please?
Yep. Matt Bucks.
But yeah, a couple things on inflation. First of all, like I've learned in terms of trying to predict it. I mean, we've had a bunch of macro experts on, excess returns, and we've tried to have people who have sort of systematic macro frameworks versus people who are just kind of reading the tea leaves. But, the divergence on them is pretty wide. So whenever I look at people that are way smarter than me, that have studied the macro economy way more than I have, and they have, one of them is, inflation is over and it's coming way down and we're going to have a recession soon. And the other one is much higher for longer. Like I have to accept that I probably can't predict this thing because there's just so, it's very hard to do if people of that intelligence level are having difficulty doing it. So I'm sure there's hedge funds and there's people who can, make a lot of money on that. But your average person, me, is going to have a hard time with that. But the other thing I would say is I do think we have to kind of, instead of looking at the short-term view for inflation, we do have to look at like the multi-decade view of it. And what I mean by that is not that we're going to have like multi-decades of really high inflation, but we had 40 years where we basically had none. And in that period, stocks and bonds is all you needed in your portfolio. And so I don't think it's trying to predict inflation to say, all right, maybe I need something else in my portfolio now, because maybe that 40 years is not indicative of the next 40 years. And so I do think like trying to, time your portfolio with what's going to happen with inflation in the next year, like you have to know what's going to happen. You have to know how much of it's already priced in the market. I mean, that's really, really hard to do. But I do think it's sensible for people to look at their portfolios and say, all right, one of the many scenarios that might happen is inflation's not going to be averaging 2% going forward. Inflation's going to be averaging something north of 2% going forward. And, does my stock and bond portfolio still work as well if that's the next couple decades?
Run that scenario analysis. I agree with that all day long. You should not be ignoring that and just assuming one future path.
And just a few other things. I think that, if you look at, to your point, Jack, the period that we were in from, let's say, '08 to 2020, was historically well below the average sort of run on inflation. It was something like, 1.5% annually versus maybe historically in the US, it's been something like 3.5% to 4% on average. And that does play into to Matt's point earlier too, interest rates. And so if you were, long duration growth stocks and benefiting from that, obviously you benefited from very low inflation and very low rates. So that's something that investors need to think about. If you were invested in the Nasdaq or these tech companies, you obviously were a beneficiary from those low inflation and low rates. So that's one thing just to think about. And then I was also sort of thinking about sort of like home ownership in the US and how, anyone that refinanced or took out a mortgage over the last 15 years is probably looking at, like, I know like my mortgage is something like, I don't know, 3.25 or 3.5% on like a 15-year. And there was 30-year rates that were that low too. But if you look at where rates are now, it's obviously much more expensive to finance or refinance your home. And so just thinking of the implications of that and how that sort of factors into overall economic growth, I think is interesting. I don't have any predictions on that other than, it's just much more expensive if you're buying today, and sort of more of the cost of owning a home and borrowing is obviously higher, and it's higher for all things, cars, homes, big ticket items that people are financing. So
can we make this clear that Justin is saying short private real estate, right? That's what I took there.
Yeah, what we're going to do, since Justin doesn't want to make predictions, is we're going to get a list of Justin's predictions on this episode, and we're going to post them afterwards.
Oh, great.
Here are the
Thanks,
things
guys.
Justin thinks are going to happen in the macroeconomy going forward.
Well, with that, let's transition to AI stocks then, if you guys want to move to there.
Jack, do you want to go first, or
I can.
do you want the song on this one?
As we move further and further to topics Jack knows nothing about, we go from inflation to AI stocks. I have a couple of things on AI stocks. It's interesting because I tend to be the value guy, and so I tend to look at stuff like what's going on in the market right now and be like, this has to end and this cannot continue. But I also think I've kind of learned in my career about that's not necessarily that is very well what might happen, but that's not the only thing that can happen. So if you look back to the internet, in terms of when the internet, like look back to 1995 or something like that, the internet was obviously a massive investable opportunity. But having said that, a lot of the names you saw in 1995 that you could have invested in went to zero. So it was a massive investable opportunity, but investing in it was very, very hard. So there's like this dichotomy going on right now that I think is the same thing with AI stocks. Is AI going to change the world? I'm actually a big believer in it. I think Justin uses it more than I do, but I think it is going to be a big thing. And I actually think at a high level, what I try to think about, like going to sort of the market as a whole, when I kind of have my, I'm shaking my fist here about inflation and valuations and stuff, one of the things I think about is like, what does the right tail look like right now? And what if what if the market is pricing in a world where 5 years from now, AI is a massive deflationary force, and it's also a force that really promotes growth? And how could that change someone like me sitting here shaking my fist about inflation and valuations and stuff? How could that world look very, very different? And so I try to do that now because I've been so wrong about this stuff in the past. So not that I think that's the base case, but I do think there's a possibility that, we might get a very different outcome in the market than we think in the next 5 years, because AI will do things that we don't believe are possible, and it'll translate up to the overall economy.
Merrill showed that in their fund manager survey, and I believe it's over the next 2 years. That just came out within the last couple of weeks. Like the fund manager survey has shown a shift in people expecting AI to be a deflationary force and therefore positive on earnings in the next 2 years. Like it's actually showing up in discussions, in presentations.
Yeah, no, that's interesting. I don't, and again, I'm not an expert in AI, so I can't see what's going to happen. But I do think, obviously we've all seen it. We all use it to some degree. We've seen it in our lives, and we can't even fathom, probably what the use of it will be and what it'll actually mean. So, if I can't fathom what it'll mean, I can't sit here and try to predict which direction it's going to go.
Well, and I think for investors, if you're a believer in this, sometimes at least from my experience, sometimes in your life, you see these from an investment perspective. You see these trends emerging, and you either can take action or not take action. And I'm not encouraging people to take any action. I'm just saying sometimes these things are in front of us and you have an opportunity to take action. And so if you decide to take action, at least from my perspective, I don't think it means going out and, betting on one company or two companies. I think if you're going to try to benefit from this trend, you want to try to be smart about it, be diversified. To Jack's point, We really don't know. There kind of seems like we know some of the companies that are going to be winners, but we don't know who the winners are going to be. And by the way, if a company is trading at 30 or 40 times sales, the likelihood is the expectations are way too high. So I believe in, if you're going to try to benefit from this from an investment perspective and profit from it, be diversified. There are ETFs out there that are trying to benefit from this trend, and that's the best way to play it. There's, of course, going to be people out there that want to buy the lottery tickets and think they're going to be right, and they may or may not be. But I just think, being diversified with it is the best strategy. And it was funny, Jack, I was looking, something on Twitter got my attention. Somebody was talking about this, and I went back to, I don't know if you guys remember this, but there was in 2000, it was March of 2000, it was a Barron's column. Jack Willoughby wrote it. And it basically was the first crack in the dot-com sort of that bear market, the dot-com bust. And he kind of highlighted like 50 companies and their burn rate, and how quickly those companies were going to run out of cash. It was something like the average publicly traded company was going to be like negative cash flow in like roughly 12 to 18 months, something like that. And that was the first signs of that decline. Now, I don't know. It's hard for me when I look at some of these technology companies today that are maybe beneficiaries of AI. They seem to be much higher on the quality spectrum, but some of them are certainly very, very expensive, which usually doesn't bode well for long-term investment returns. So I just think being diversified with it is the smartest way to go.
Yeah, now as I transition from technology bull Jack to usual Jack, what I would tell you is, if you use base rates, what is the track record of paying 40 times sales for a company as large as NVIDIA in the past? Well, first of all, the base rate is there isn't one because no one's ever done that before. But second of all, as you move down to 30, 20, 10 times sales, it's not good. So the odds of and again, we're not talking about individual securities or recommending individual securities, but like the track record for paying those kind of multiples for a company is not very good. Your odds are not, the odds are not in your favor if you do that.
So let me interject with Mr. Roboto by Styx, clearly the song for this. I don't think there's any question about that.
Nice.
But beyond Domar Arigato, Mr. Roboto, and declaring ourselves Kilroy, I think when talking about AI with clients, the other thing we keep separating is there's a difference between the hype cycle of a new thing and then the product adoption life cycle. And as we learned from Crossing the Chasm back pre-tech internet boom and everything else, the hype cycle is where you can't pick between pets.com and Amazon. The product adoption life cycle is where we actually see these things integrate, and then who's going to take control of the stories and the narratives around these. Ben Hunt's work on narratives and how those spread, and Michael Hartnett and the Flow Show at Merrill, which I still think is one of the most valuable pieces of research produced on Wall Street once a week. What they look at literally is where our flow is going into things, because beyond valuations, beyond hype cycles and whatever else, how do we see people voting with their feet, voting with their money on what they're investing in? And then how do we frame that back through how those things can be adopted? Are there big ideas coming in AI, in tech, in these places? I think so, but it'll be dependent on the productization or turning these things into actual businesses, and then how those businesses continue to explain what that means to their shareholders. And kudos to NVIDIA, not an NVIDIA pitch, kudos to NVIDIA for controlling that narrative right now on saying, we're the one product you can invest in to express your AI idea. And now we've got some securities firms, and we've got, the Microsofts and the Googles and whatever else throwing their hat in. But this is going to be about who controls the story and if those businesses actually build underneath them, because that's where Amazon came from. I trust you to take my credit card and buy a book once in a while actually works out to something. So careful what you do. Don't get burned. Don't do anything stupid. But I'm with Jack. It's a really interesting idea. I'm also with Justin. Don't get your face ripped off because you thought, a lottery ticket was a treasury bond.
Yeah, maybe the best example of that hype cycle versus actual use thing we've ever seen in history is crypto. If you think about it, look at all the value.
Never found a use case.
Yeah, look at all the value that's created in crypto, and then at least at that point, and again, I'm not a bear on crypto long term. I don't know what's going to happen.
Hasn't found a use case.
Right.
Thank
there was nothing.
Well,
right? I mean, basically, all those values. I mean, most of those coins did not have any real world use case where actual average people were using them for anything.
Yeah. Now, the only thing I'm not going to, because we'll maybe talk about this some other time, but I actually did have a use case for crypto that I ended
You have one
up
for Bitcoin, right?
For Bitcoin, yeah.
Yeah, I was kind of talking
yeah.
about all the other ones, but
I got you.
And there
Yeah.
there potentially will be great use cases for that. It's just, again, to Matt's point, like the hype cycle on a lot of the secondary coins got way beyond what the actual
Right.
use cases were, because the
Right.
use cases
There was
just
no
weren't
use
there
case.
yet. Not that
Yeah.
they'll never be there, but they weren't there yet, and the value of these things went like up exponentially.
Yeah. So to kind of latch on to Matt's flow point, what was that weekly report, Matt, that you said you referenced?
The Flow Show, which Michael Hartnett and his team post at Merrill Lynch, but you have to be either a client or have an institutional relationship to get, or know sneaky people on the internet who will slide you copies.
Yeah, but to sort of transition that to sort of market valuations, because if more flows are coming into the market and there's more demand for stocks, that effectively will drive up overall valuations in certain companies and or the overall market, depending on whatever index you're looking at. But because this was a topic that we wanted to discuss, and I'll let you guys go wherever you want with it, one of the things I was just trying to think about, like, has any client ever talked to me about market valuation? And I would say the answer is I don't think so. But what clients do talk to me about, and it relates to market valuation, is when you have something like the S&P that's market cap weighted, delivering one type of return, and we tend to be more value stock, equal weighted, small, mid caps. Sometimes our strategies are delivering another type of return. That's where the conversation around market valuation tends to happen. It happens indirectly in that, the S&P did this, plus or minus whatever your strategies did. And so it's almost like most of the time when clients are there's a fear of missing out, it indicates, to me at least in my experience, that there's some probably overvaluation in the market over most other stocks, something like that, like with the S&P. So that's kind of like, I'm not going to, Jack, you probably have other thoughts on market valuation. I'm sure you do too, Matt, but that's kind of how what I was thinking about, this topic with working with clients.
So Kendrick, I'm taking Kendrick for this one. How much a dollar cost? Where in a matter of lines, we get the crackhead on the street corner and like wanting to feel like Matumbo, and value versus growth, or value versus growth versus the benchmark. If we're talking about stock valuations, all of these are perspective-based narratives on why we think something exists. And so we talk about valuations in that way, in that framing to clients all the time, because valuations are always a behavioral phenomena. And that's why we think we think factor premiums and those things exist. However, that fundamental question of how much does a dollar cost? Well, is the dollar worth 30 cents right now, or is the dollar worth $2? That's the internal and the interesting question here. So what's weird is anytime you have a valuation argument, you can basically assume that somebody is showing their bias by telling you what their valuation argument is. But what our clients get, and what I think is the most important thing, is valuations are broadly elevated right now. There are pockets of things that still seem cheap. The bastardization of Kramers, there's always a bull market somewhere. And if you have people, like in our case, a lot of business owner clients who understand reinvesting in their business, which is a fancy way to say they understand reinvesting in quality. And if you understand reinvesting in quality, then you want to adjust these things and say, where's the cheap quality out there in the world? And no surprise, there's a bunch of stuff where you can say, if valuation matters to you at all, let's talk about where the attractively cheap value opportunities with a quality factor are focused. And even in a period like this, they're abundant. So careful for the headline stuff. But if you're willing to look beneath the surface, holy crap, there's good stuff out there.
Yeah, no, I think that was going to be one of the points I was going to make. But in terms of overall market valuation, I think the average investor should look at that as useless. And the reason is, so in terms of like the next 1 to 3 years, does market valuation tell us anything? No, it tells us zero. Now, where can it be useful? It can be useful in predicting 7 to 10 year expected returns. So market valuation is very high, 7 to 10 year expected returns lower. But then let's think about this from, Matt, you work with clients. Let's think about this from a practical perspective. All right, 7 to 10 year returns, much lower. What do I do about that? Oh, let's de-risk the client portfolio. Well, guess what? What if the path of those returns is 20% up this year? Now you're in huge trouble, because now you just de-risk the client portfolio based on a 7 to 10 year projection. And now I got killed, the first year is way up. So since we can't predict that path, I think those 7 to 10 year return expectations things are very interesting. I think it's good to know. I think you want to know, like, if the market is crazy, highly overvalued or something, but I don't think in the real world there's much you can do with it.
We look at like those valuation gaps all the time, and we're literally looking for the gaps in the extreme measurements, and we're looking at stuff like just as an example, like an equal weight S&P versus like a cap weighted S&P. This was part of our investment committee call like a week ago, and just going, hey, we've got a bunch of data that shows this is the biggest gap in a while that this has existed, just between the valuations and recent price returns. And you can look like that at that stuff, and you can take semi-tactical tilts when something gets like way out of historical whack or alignment, looking for that snapback to occur. But you do so with the idea of what you just said. Like, we have a 7 to 10 year view or whatever our capital market assumptions are, and then we're looking out for stuff when it gets really out of whack to lean into shorter term opportunities, but do that with extreme caution. And
yeah, it gets back to what you said is exactly right, and it gets back to Cliff Asness's sin a little. Like, I wrote an article about factor timing that I called like sin less than a little, because I think that's the idea is, yeah, absolutely. Like, if a certain factor is cheap, like value, it can absolutely make sense to add exposure to it, assuming you can stay the course through until things get better. Or, what you were talking about with the equal weight S&P versus the overall S&P is something we're seeing a lot in our data too, which is the median stock right now is way, way cheaper than market cap weighted indexes. So market cap weighted indexes are way up in terms of percentiles. The median stock, actually looking back the last, I think we have like 15 or 17 years of data on our tool on Validia, like, is below average right now. So it just shows how massive the gap is between how expensive the big stocks are and how expensive, sort of the median stock out there is. So yeah, is that an opportunity for people? Yeah. I think for people who can do it smartly and say, not only am I thinking something is sort of out of whack in the short term, but I'm also relying on what works over the long term. Like, we know if we use valuation or if we use value over the long term, that can add value to my portfolio. So yeah, do I think that can be a sensible move? Yes, as long as you understand that you're going to probably get punished in the short term for a while, you're going to be early and you're going to have to sit through it. And we definitely do that some as well for clients, but we'll always do it the way you talked about doing it, which is it'll be a very small thing. It'll be a small tactical thing, and it won't be like, let's make some massive move in here because we think value is like the opportunity of a century.
Sit a little.
Exactly. Or less than
Matt. So one of the sort of hot topics, and this is interesting, I'm interested to see where we go with this one, is around a recession, I guess, maybe later. Some people say we're in a recession. Some people say there's going to be one at the end of this year, maybe early 2024. Obviously, with what the Federal Reserve has done with interest rates, and then the fallout of some of these regional banks, had a lot of people. It seems like earlier in the year there was more recession talk. I feel like the market, and given the market's performance and the performance out of the average stock, especially in June's been a good month for the market, and the breadth has sort of broadened out in terms of better performing. So it seems like the market is sort of sniffing out that maybe it's going to be a softer landing, or maybe we're going to skirt a recession. I don't know. I don't think that those...
Are you suggesting the price is dictating the stories we're reading in the headlines?
It might be. I don't know. But, let's just have... what do you guys think about? I have some other thoughts on recessions, but what's generally your take on this?
Yeah, well, what you said is true. The market was predicting a bunch of Fed rate cuts a while back, and that's kind of gone away now. So yeah, the chances, like the market is saying, the chances of recession are less. Again, like this is another thing that goes back to our inflation thing. I have no idea how to predict this. If you do look at history, what it will tell you is trying to break inflation without a recession at some point is going to be very difficult. The whole soft landing they're talking about, that's going to be very, very difficult. And like the macro guys who've studied history will tell you, like, that's a very, very thin path we've got to make that happen. Typically there has to be a recession at some point to break inflation. But then, like, how do you get there? When does it happen? How deep it is? Like, the problem is all of that is really, really difficult to predict. So again, we kind of go back to what we've been talking about, which is, like, I can't really do anything in my portfolio because we're going to probably have a recession at some point, because I have no idea when it's going to come. I have no idea how deep it's going to be. I don't know a lot of other factors that are out there. So I don't know what your take is, Matt, but my take is kind of, I really don't know here. Although it seems likely a recession is probably coming at some point in the next few years.
The next recession is always around the corner somewhere. We just don't know how far away it is. Notoriously hard to predict. There's not a lot you can do about it. I always go back to the idea that at least in the US, We're talking about 70 to 80% of the economy is consumption. It's really hard to have a recession if labor is not falling apart or we don't have some big drawback in consumption. The song I'm going back to on this one, I got another maybe even deeper cut for you here. There was a brief hit song in circa like 1996 by this woman, Tracy Bonham. It was Mother, Mother. Does this ring a bell at all to you?
I don't think I know that one.
No, I don't know that one either.
All right, this is a deep cut. Classic lyric was, so Mother, Mother, how's the weather? Basically this girl calling home, kind of Welcome to Paradise by Green Day-ish, only less optimistic, and that she's calling home and saying, I'm hungry, I'm dirty, I'm losing my mind, but everything's fine. And it's like this thing of like, she's throwing this tantrum, but at the same time, everything's fine. And I feel like what we saw at the beginning of the year was that we had this big like panic. The Fed's going to have to cut rates all these times. All these things are going to go wrong. Equity market returns are going to suck. And we were like throwing this fit. And now we've moved into the everything's fine phase of it somehow. I don't think those problems are resolved. If inflation doesn't just magically go away, like it just is uncomfortable for a while, maybe we have a soft landing, maybe we don't. Maybe we have an earnings recession without an economic recession. Maybe we have an economic recession, but earnings kind of hang in there. Anything can happen here. We just have to stay sort of aware of if it's going to get really bad and we're going to veer towards something else. Hey, we just had a bunch of regional bank collapses and the world didn't end. Like, is that just smoke and there's no fire? Or are we about to all go to hell? I don't know.
One of the things that has happened in the last 50 years is recessions have become less and less frequent. So the economic cycle seems to be, longer. And if you think about, we had a recession in 2008, 2009, and then we didn't have a recession really until 2020. And that was, kind of due to the pandemic. And that was very short lived given, how the government and the Fed intervened there. So one of the questions is, and I don't know what you do from an investing standpoint, probably nothing, but, are recessions in the future going to be maybe less than they have in the past? I don't know, but it's just an interesting sort of trend that has sort of developed post World War II. The other thing I was thinking about is, two other points, is that I think for long-term investors, people that have, decades to invest, it's like recessions, you just deal with it, right? And you stay, invested and keep that long-term mindset. But where I think recessions do play maybe a more important role is if someone's just entering retirement and you go into a bear market due to a recession, there's obviously much more sequence risk there for the investor and their portfolio. If you take big losses up front, that can have a big impact. So you want to make sure that, I guess, you're positioned correctly and diversified. And we've talked about this on multiple podcasts. So that's just the point I want to make. And then the only other thing is, with recessions, usually the worst bear markets happen when you come into a recession and the market's highly overvalued. So, that may not have been true with the financial crisis, but certainly true with the 2000 to 2002 bear market. And in the 1970s, you had, an overvalued market, and then that was coupled with, a mediocre or deep recession. And so from an investing standpoint, you just want to kind of, and then maybe that plays into the other valuation sort of discussion, is when we go into recessions and the market's overvalued, that's when stocks tend to have historically their biggest losses.
I think we have to connect this too, because we can say, I don't know what's going to happen. I will gladly say, I don't know what's going to happen. But the other thing, when we talk about sequence risk and we talk about recessions through the lens of being investment professionals allocating money, we also know that so far in 2023, we just got a better than average or better than expected result so far, at least on our domestic large cap US assets. And the thing here, it goes back to that idea that we've talked about. I call it the Little Mac Star Punch. When stuff is going better, you saved up that Little Mac Star Punch. And so when stuff is going good, like, just take some off the table. If you made a lot of money in high yield credit over the last few years, go shift up the capital spectrum a little bit. And if spreads widen out or stuff gets worse from here, be ready to throw the star punch. Rebalancing works. Rebalancing works extra well if you can over rebalance. And that's the kind of stuff you want to be teeing yourself up for, not being right about if the recession happens, being able to take advantage of an opportunity if it presents itself. And right now, surprise, surprise, we've gotten kind of better returns than we expected, at least in the US.
Yeah, and that gets back to the idea of like, I think it's really important to put yourself back in your shoes you were in at a given time. Like, and so think about yourself on January 1st of this year and like, would you have predicted what's actually happened in the market? I mean, most people would not have. I mean, it was a much more negative world then. People were much more doom and gloom. And, again, I don't know. I mean, we might collapse the rest of the year and we may have...
My AI advisor would have predicted this.
Yeah, exactly. Because it's all knowing now. But I just think it's really important, like with anything in investing, where you think you can predict something, to go back and put yourself in your shoes at a certain point and say what actually happened. And that's why we just put this quote from Tobias Carlisle up on Twitter this week from our closing question of our other podcast, which is, and his idea was, well, the closing question is, if you could teach one lesson to the average investor, what would it be? And his idea was write things down. And that's why it's so important to write things down, is like, if you can write things down, I can put myself in what was I thinking at this time, and then what actually happened, and then I can be better at judging myself in terms of, did I really see, this 15% return in the first 6 months of the year coming in the market, or was I really doom and gloom at the beginning and I didn't see it coming? And that goes for recessions and inflation and all this stuff. Is like, if you're gonna predict the stuff, write it down and then see how you actually do. Because a lot of times you're going to realize you're maybe not as good of an expert as you think you are. At least I am not.
So the last point we wanted to hit on is around political and geopolitical sort of turmoil or crisis or whatever you want to call it, and how it matters to investors, how it matters to markets, and the way to think about this. And I just have two things to say on this, and then I'll hand it over to you guys. But the first is, there's this chart that always goes around that shows, going back to World War I, like all the different crises and wars and things that we've gone through as a country, and how, over time the stock market has gone up. And Warren Buffett obviously emphasizes this a lot, which is, we've been through a lot as a country, as a world, and and yet stocks have delivered, the return that they've delivered to investors. It hasn't always been easy, but over most 10-year time periods, stocks have produced positive returns. That's, most people, I guess, know that, but that's just one point I wanted to make. And then it's also, I feel like with this, it's like the market becomes and investors become callous to what happens. So, Russia invades Ukraine. Obviously, it's, very sad, and it's, from a humanitarian standpoint, and also it has economic ripples across the world, but yet the market sort of digested it, and there was an initial reaction to it, and then over time it's like it becomes used to it, almost like with these types of conflicts. So it's like, I think, like that, from my experience at least, that's what I've seen. It's like investors become almost like callous to it to some extent, and so it becomes like what Donald Rumsfeld has often said. It's the unknown unknowns with geopolitical stuff in the markets. It's like the stuff that we can't see, we can't predict, that sort of can really shock the market, at least in the short run. But over the long term, this stuff tends to not have long lasting, what I'm saying, like 5-10 year sort of effects on the overall market.
Yeah, and the problem is the unknown unknowns are the things you really can't do anything about, like, because we have no idea what's happening. But like, thinking about the risks people know about, like the greatest example to me of the geopolitical stuff, or like politics coming into investing, is the Trump-Biden election. Because if you think about what was happening at that point, coming into there, we were going to have basically a disputed election. That was a huge risk, and Trump wasn't going to leave the White House, and like all this stuff. And for the most part, that's what we got. We got the disputed election, but then the only problem is the market didn't go down; it went up. And so that's the hard part about these things, is if this stuff is known, if it's out there, like, the market is digesting this, it's figuring it out. And some of that stuff might have been to have to do with option dealers and stuff, the fact that the market rallied right after that. But, the market knew what was coming, and, what potentially could come, and it priced in a risk of that, and then it kept going up. And so like the market will take a lot of this stuff. If it doesn't affect the economy, if it doesn't affect earnings of companies, it'll take a lot of this stuff and kind of put it aside. As much as like it's in our minds, it's on Twitter, people are rambling about it. Like the market will say, like, what is the discounted cash flow of future, discounted value of future cash flows, and how does this impact that? And, and a lot of if you look at like the Trump-Biden thing, it didn't really affect that in many ways. And so the market kind of looked through it. And so that's the hard part about these geopolitical events, is like, first of all, you can't predict the event itself, and second of all, even if you get the event right, like a lot of people who got that event right, the disputed election, still lost money because they were just wrong. So I mean, we're probably getting as far away from our ability like our personal knowledge as we are here, as we can, like talking about geopolitical stuff. But that's kind of the way I look at that is, it's just very, very difficult to try to make any money off that stuff.
Al Green in Love and Happiness says, love will make you do right. Love will make you do wrong. And if you're in love with something, an identity, be it a political party, a political belief, or something else, it will betray you when you're basing that self-belief against things like the markets. And to me, that's the most important thing to remember when we're taking a stance on a political view or a geopolitical event is don't be in love with one of your ideas in such a way that you can only see one future outcome, because that will betray you. Love can make you do right and love can make you do wrong. So when we think about this, I always frame it back to just like the AI part of this conversation. We have to think about flow. We have to think about product. We have to think about the adoption of the ideas. If we're talking about the debt ceiling, we always have to talk about who wants to be the last politician in line that basically screws something up for Social Security, and how do they feel about that for their reelection ability. When we talk about Russia, Ukraine, or wars or any of that stuff, we have to talk about what does realigning supply chains globally mean. You can construct that into your outlook and your investments. And for people who want to do that, that's the way to look at it, but you can't be in love with your thing so that you only see one path going forward. The minute you confine your view to tunnel vision and you're trying to deal with markets, that's your death sentence.
The greatest example of that, by the way, is the whole thing about elections and whether Republicans or Democrats win. If you ask people which party does the market do better under, they'll say whichever one their party is. So they'll say Republicans or Democrats. But one way you could look at that is look at the actual data and see what's happened in the past. And the answer is it's almost a wash. It's very close, but Democrats win by a little bit, but it's almost a wash. So the point is, like, probably which party wins the election is not going to impact the market too much one way or another. And in history, people might think, just off on the surface, they would say Republicans, tax cuts, whatever, is good for the market, but the data doesn't back that up. And so that's a really good example of, somebody who's a staunch Republican or a staunch Democrat might have this really strong view about, well, that personal view I have, the economy's going to hell and the world's falling apart and the market's going to collapse if the other party wins. But usually that's not the way it plays out. Usually it's pretty down the middle in terms of how it plays out. And usually the forces that determine that are not who wins the election.
If you're on the battlefield of the market and you're just going to put the bandana over your eyes and just walk forward because the one true path, again, I just think it's a silly way to invest your money or do your planning because nobody can know.
So listen, anyone that's made it this far, thank you very much for hanging out with us and listening to us riff on all these topics that, we find interesting. We hope you find them interesting, and we'll try to do this once a quarter. If you have any feedback on things you'd like us to talk about, let us know. We're happy to tackle those subjects.
By which you mean we're happy to say, I don't know.
And for anyone that listens to this and can name all 5 songs that Matt referenced, we will give you a free account to our premium investment research site if you're interested. So drop us an email at, Jack, what's our podcast email?
excessreturnspod@gmail.com.
excessreturnspod@gmail.com, and we'll hook you up. Thanks so much. Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.